Hello and welcome to Daily Trader for October 25th. It is Friday and it has been a roller coaster ride of a week here for the U.S. equity market. But as we sit about an hour into the trading day here on Friday to close out the week, a lot of green on the screen. S&P 500 making quite the comeback. The NASDAQ 100 also making quite the comeback. This in the face of what's been a consistent trend to the upside in yields over the last few weeks. So we'll see how things shape up to close out the week. But right now, a positive note being struck by the equity market as the S&P 500 trades up almost 50 points, and the NASDAQ 100 up over 300 points as we speak here, about, again, an hour or so into the trading day on Friday to close out the week. We have a couple example trades that we want to take a look at here, both in names that have already released earnings for this quarter, and also both of them that notched their best days of the year, in the case of one of them, the best in over a decade, in reaction to said earnings. Two of the most important names when it comes to the sentiment that investors have around the market, those, of course, Tesla as well as Netflix. So looking forward to looking at that. Let's jump right into it. The first one that we're taking a look at today is Tesla. Tesla reported its earnings earlier this week, notching its best gain in response to these earnings since May of 2013, as the stock jumped over 20% in response to the better than expected earnings by a wide margin, but a lot of that driven by margin expansion. So something that's a bit of a theme in both of these names. Now, as we see Tesla on a technical basis get back to that level that it has failed from a couple times this year in this sort of 265 to 270 zone, of which it sort of sits in as we speak, perhaps a trader who feels optimistic around the electric car maker could see additional upside over the next few weeks. And so I looked at a strategy that first and foremost is risk defined, but would benefit for, let's say, a test of the 300 mark. What we looked at here is a traditional butterfly spread. Because it's bullish, I elected to use calls for this example. But a butterfly spread is something that oftentimes is associated with low notional risk relative to the reward potential, but is also a little bit more about precision and accuracy in terms of strike selection, because it really does well when a stock goes to the short strike. So in this particular case, we went out a few weeks, went out to the November 15th monthly cycle, and we're looking at the 285, 300, 315 call butterfly. So what you'll notice first and foremost is you are essentially buying a debit spread and also simultaneously selling a credit spread. In the case of the butterfly, those short strikes overlap at one mark. In this case, that's the 300 strike, and it creates this risk profile that almost looks like a pyramid. It's going to do best if it moves right to your short strike, and that makes sense, right? Your debit spread would be working towards max value, all the while your credit spread would be working towards zero, which is the best of both worlds. And the reason a trader may do this type of a strategy is because the debit spread on its own may cost a little bit more. By selling that credit spread to create the butterfly, it reduces that risk, reduces that debit in exchange for upside risk. So what you'll notice is there's risk in both directions on this. So while it's a bullish trade, it can certainly go too far. But let's look at the exact specific details of this particular one. If done for a $1.50 debit, your break-evens theoretically at expiration would be $286.50, so you need a little bit of help from the market based off where the stock is right now, and then all the way up at $313.50 if it did really get its bullish legs under it and make a run to the upside. Now with this, you'll also notice that, of course, the max loss then is limited to that debit spent, which is $150. Relative to that reward potential, which, let's be fair, not the greatest likelihood that you'd be able to capture that full amount. You basically need it to be right at your short strikes at expiration, and all of these options expire worthless. But theoretically, the max profit is $13.50. So $150 compared to $13.50, obviously a lot more reward potential than risk. So whenever you see that, I also say, probably doesn't mean that the probabilities are super favorable. You need something to happen, and you need a specific thing to happen, which is a move towards 300 for that to work out that way. Most traders would look for a move towards 300. The closer to expiration that you get, oftentimes the more the butterfly expands. But they would oftentimes look to take that off, if possible, market open liquidity provided prior to expiration to avoid unnecessary expiration risk around assignment or exercise. Let's shift gears here, talk another name that had big time margin expansion celebrated by the street. That, of course, is Netflix, chalking up a really impressive jump as well. Biggest in over a year for Netflix. So not quite as big in terms of the market reaction as what we saw in Tesla, but still quite impressive in its own right. The name that oftentimes kicks off sort of that high-flying tech trade when it comes to earnings, is an earlier reporter when it comes to the calendar than some of its peers. So let's talk some Netflix. Again, another name making, in this case, a new all-time high in response. And say a trader or investor sees that, perhaps in a technical way, sees that as a breakout and perhaps letting a runway for more additional upside. If you're in that camp and you wanted to look at a bullish strategy, there's a couple things to think about with Netflix. First off, really, really big underlying in the case of the options. And what I mean by that is you're talking about a stock that, here on Friday is trading for almost $770 a share. So every 100 shares of that stock is $77,000. Well, we know options, in theory, are potentially going to turn into 100 shares of stock. So that's a big product. This is a lot bigger than the case of Tesla by a factor of 3. And so we're looking at this. Risk-defined option strategies are ways that you can kind of reduce that overall notional risk theoretically, but still participate in a name. So what I looked at here was sort of a variant of what we just looked at in the Tesla example, which is a call condor spread. So rather than in the call butterfly, where you had that call debit spread and the call credit spread overlapping at the exact same strike, in this case, we have those two pieces, but we've separated them. So rather than it having a pyramid risk profile, it's going to have a more plateau-like risk profile. Now, the strikes that we looked at specifically here, again, that November 15th expiration cycle, buying the 785 call, selling one of the 800 calls, so it's a four-legged spread, selling one of the 825 calls, and then buying the 840 strike call. So with this strategy, you can see where we're at right now is below all of those options. And because it's done for a debit, that means you're going to need to move higher in order to break even. You can see that first break even. If this is done for a $3 debit, as we have for the example, you'd be risking $300, and you need to move above 788 to hit that first break-even mark by expiration. Now, this is one that does best if it hits a window. So rather than it perfectly pinning 800 or 825, it just needs to get in between those two levels. So in this particular case, a move up and through 800, but not through 825 is the best case scenario. And in this case, it can expand up to a $1,200 profit. So a 4 times greater reward potential than the theoretical risk, which I think for those who are bullish could be interesting, especially if you think it can. You could kind of target a window of, let's say, $25, like in this case, where this stock could end up over that said time frame. Now, again, just like in the Tesla example, there is risk to the upside, and the risk, of course, is that it runs through 825, breaks through that break even at 828, and then goes, or not 828, 837, and then goes all the way through 840. If that happens, of course, you would have that $300 at stake, would be at full risk. So 837, 788, stay in between those two marks, or get in between those two marks, can at least break even, a move between 800 and 825, max profit potential. So two names, big time earnings moves, and for those who think more upside is in stores, perhaps two example trades to consider, at least in terms of strategy. Thanks as always for tuning in to the Daily Trader here on the Schwab Network page. We look forward to seeing you again tomorrow.